Welcome to Reflections 2020. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And I'd like to take a look back at the industrial sector and how it was impacted throughout this strange 2020 year. I thought I'd go through industrials and take a look um, at a few different segments. So I'm going to start off by just keeping perspective. I think keeping perspective, looking at the big picture is really important as we look at 2020 because there was obviously a lot of volatility. So I think taking a step back, looking at the big picture and putting it all in perspective is very important. The second segment I plan to cover is 2020 hindsight industry groups. So I figure since it's 2020, why not use 2020 hindsight? Go back, take a look at what happened, what transpired among the industry groups within industrials, and see what we can glean from that. The third segment I think is important is to see how industrials came out of all this. Of course, COVID-19 consumed just about everything stock market related in 2020. But the stock market toward the end of the year is now beginning to look past the virus. And so I think it's really important to see what Wall Street is looking at in terms of potential strength as we move into 2021 and beyond. And then I'm going to wrap up with a final segment, which are stocks to watch as we move into 2021. I do think that there are a few handful of solid industry groups that Wall Street's telling us to take a look at. And I believe that there are some individual stocks within those groups that are poised to benefit in 2021. So my plan to try to get through this presentation on industrials and how this sector was impacted throughout 2020. So I'm going to start off by keeping perspective. And so looking at this first chart here, this is the XLI Industrial Select Sector SPDR Fund. This is the ETF that tracks the industrial sector. And when you look at a 5-year chart, if we could just cover up the temporary healthcare issue that is COVID-19, I think you would see, and I'm just trying to, draw a line almost like right across to where we are now. If we could somehow just cover all this up, the slow push to the upside that we saw moving into 2020 literally could have just continued all the way through the end of 2020. But obviously that's not what happened. And it was a very difficult period for just about every area of the stock market. And I would say industrials were hit more than their fair share to the downside. But my point here is, when we look back, industrials have been climbing. We had trade war related issues in 2018, 2019, but we were sitting at an all-time high in February of 2020 when this hit. Now, I think it's worth noting here at the bottom, I have a relative chart of the industrials relative to the S&P 500. And even though we were moving higher throughout 2019 and set that all-time high in 2020, you can see that relative strength had already begun to deteriorate in the group relative to the S&P 500. Industrials were not leading. They were going along for the ride, but they were not leading. And I think that's really important because when COVID-19 really started to dig in and we started to see more and more cases here in the US and realized that we had ourselves an issue and we were going to have to go into lockdown and we're going to have stay-at-home orders and so forth. Many of the industrial groups obviously took a massive hit. We're going to take a look at some of those in a bit. But you can see 4 or 5 weeks, the damage was done. And this is typical, by the way, of a cyclical bear market within a secular bull market. We were at an all-time high when this started in March. And as we get ready to close out 2020, we're at an all-time high again. We're in a secular bull market. But this was one of the worst cyclical bear markets we've ever had in our history. And so I would say that this was very similar to 1987. It wasn't similar so much to 2008 because we were in the midst of a secular bear market, a long-term bear market. And we saw the big drop with the financial crisis in 2008, but that came on the heels of a couple of years worth of weakness even before that, or a year and a half. So I think as I look back at 2020, I'll just remember the steep 1987 crash-like move in the overall market, but especially in industrials over this 4 or 5 week period. Now that's the 5-year weekly chart. I'm going to take you out even further. I said, when you're keeping perspective or you're trying to gain a perspective, you need to look at the big picture, the long term. Now, I know back in March and April, this was nothing, this didn't seem like it was no big deal. It was a big deal. It was a big deal to a lot of us and still is. But you have to understand how the stock market works. The stock market is based on, our stock market is essentially valuing companies based on their future growth and discounting that future growth back using current interest rates. And current interest rates are still extremely low, historically low almost. And as we look out to 2021, I believe there's a lot of pent up demand. I believe we're going to have a huge GDP in 2021. I think that there are folks not just here in the US, but around the world that are going to be very anxious to get out, to spend money, to travel, to do a lot of things that they could not do in 2020. So I believe we're looking at a really strong year. And I think that's what the market's telling us as we close out 2020. I think that's why you're seeing industrials at an all-time high as we get set to close out the year. Another chart here. Now this is, this is just a 1-year daily chart. And the reason I wanted to point this out, we just took the long-term perspective. And of course, here was what we saw back in February and March, a lot of selling. I do want to point out one thing on this daily chart though. And this was something I pointed out earlier in 2020 in some of my blog articles. Notice on this first move down at the end of February, look at the accumulation distribution line, take a big hit to the downside. Then we bounced, got a little bounce in the AD. And then over the next 3 weeks in March, we had a huge drop in the XLI, and yet the accumulation distribution line was going up. And the reason that happens is you get a lot of closes near the highs. You see all these hollow candles where we were closing up near the high of the day? That is telling us that there was a lot of accumulation that was taking place. Even though prices were going down, we were seeing a lot of accumulation. I think that's really important because that set the stage for this being a cyclical bear market. Wall Street was not panicking out of stocks. Individuals were panicking out of stocks, and Wall Street was saying, thank you very much. We'll buy every share you want to sell. That's what this AD line was telling me. And sure enough, you can see we rallied right back up. We were down as low as 47.5 on the XLI. And as we prepare to close the year out, I'm doing this as of December 9th. But you can see we're almost a double where we were back in March. And yet we're not much higher than where we were back in February, keeping it in perspective. Big drop, several month long recovery. And now we're back to where we were because the market, again, is looking at this as a health crisis, not a financial crisis. I think that's important to draw that distinction. Okay, one last chart. I think I might have said that was my last one. I want to do one more chart here, and this is the XLI versus the S&P 500. And this is one of the reasons why I'm kind of bullish the industrials as we head into 2021. Last few years, and this I was showing you earlier on that weekly chart. I'll go back and show you that. See how we were moving up in 2018, 2019 in absolute price, but we were moving down on a relative basis. Well, this is the weekly chart going back 3 years. So this is the weekly relative chart, XLI versus the S&P 500 going down. Here was the first part of the year with, of course, COVID. And you can see the relative weakness that took place. So even when we started bouncing on an absolute basis, we were still going lower on a relative basis. So we were bouncing, but we weren't bouncing as much as the S&P 500. Starting in May, that changed. And now you can see we're in a solid uptrend on a relative basis. We are trending above that relative 20-week moving average, which has now crossed over the 50. And we have a relative PPO that is as strong as it's been at any point over the last 3 years. I think this is pointing to perhaps a lot of infrastructure work in 2021. I think we're going to have some various stimulus packages still that are going to come out of Congress. And I think industrials are going to benefit from some of that. And I think that's what the charts are telling us, that Wall Street is getting in position to benefit from these various areas. So anyhow, that was keeping perspective. So that kind of gave you the big picture overview. Now I want to give you a walk down, with 2020 hindsight. I want to kind of walk down memory lane here, going through the various industry groups, looking at them relative to the S&P 500. Now I'm going to go through these pretty quick because there are 16 of them. But notice it's 3-year. These are all set up the same. So it's a 3-year relative chart. And then at the bottom is the absolute. I'm just going to focus on relative strength, though, as we go through these. So we were already looking at waste and disposal services, showing some relative weakness at the end of 2019. We had a quick surge in 2020. And even through the middle of March, we were doing pretty well. And then the bottom fell out. And you can see we're still down near close to a 52-week relative low on waste and disposal stocks. Trucking actually looks pretty good to me. We went higher. We pulled back over the last few months on a relative basis, but I think we're consolidating. I'm not going to say this is one of my top 5, but I think that this is a group that's going to do well in 2021. So I would look to see if we get this bounce off of that relative 50-week moving average. Then we move on to business support services. Business support services took an initial move to the downside on a relative basis, came flying back, and then over the last 5 months or so, we've been trending back down again. So I just see this more as a neutral kind of a group. We got hit, we rallied, and now we're kind of settling back down. So on a relative basis, we're not far really from where we were when we opened the year. In diversified industrials. Now, this is a group that's been going down for a while. It's finally beginning to show some strength. The relative PPO has gone positive. I think that these are all good signs. I just don't know that we've done enough yet because we were trending lower, relative lows that were lower than the prior relative lows, relative highs that were lower than the prior relative highs. And so I'm just not sure until we start taking out some of these prior relative highs that I'm ready to really go in on these diversified industrials. Next up, industrial suppliers. This actually does look like a pretty good group to me. We saw a little bit of relative weakness back in March, but since then, we have really been coming back up on a relative basis. And you can see the relative PPO has been weekly. Relative PPO has been in positive territory now for about, probably more than half a year, maybe 7 months or so, maybe 8. So this is a group, and looking back over the last 3 years, we're breaking out to a 3-year relative high. So industrial suppliers, I think, look very interesting. Defense stocks, I would stay away. They continue all year long. They've been underperforming the S&P 500, and they're setting new relative lows as I speak. I would stay away. You want to at least begin to see some recovery. I don't want to be a hero and try and catch the actual bottom. Then you've got heavy construction. Heavy construction looks good to me. Very solid recovery off the July double relative bottom. And look at that weekly PPO, as strong as we've seen by far over the last 3 years. Wall Street's moving into this group on a relative basis. We're seeing a lot of rotation, and I think we need to be aware of that. Transportation stocks. Now, transportation stocks certainly look like they're gaining a lot of strength to the upside. And we've got this relative PPO that's now +4, but this is a group that's been beaten up really badly the last several years. And so I don't know how much of this is just maybe a dead cat relative bounce versus the real deal, but I want to see us take out that January high, at least, move up to about a 1.5 year relative high. And then I would begin to take the group a little bit more seriously. Industrial machinery continues to trend higher. I think this is a decent looking group. I'm, again, not going to say it's one of my favorites, maybe not my top 5, but I think it's a strong group as we head into 2021. Railroads are starting to strengthen, which is good. Not showing a lot of relative momentum, but certainly moving to the upside, put in that relative double bottom earlier in 2020, and we have moved to more than a year relative high. We set that back in September. So I think this is another group that looks pretty good. And transports in general, you want to see those perform well. And I think we're getting that here. Let's see, next up. Marine transportation. Now this group was really beaten up badly. And you can tell on a relative basis, when you start seeing -15 on the PPO, there was only one group that did worse than that. I'll get to in just a couple minutes. But -15 on a weekly PPO is really, really bearish momentum to the downside, accelerating bearish momentum. And you can see the relative weakness was just awful for this group. Moving on, building materials. Building materials, I think, look very strong. This is a great recovery on a relative basis, breaking out in October to a 3-year relative high. The weekly PPO looks really strong. That relative PPO looks great. This is one of my top groups. Aerospace finally in November with the vaccine news started to show some strength on a relative basis, but we're still slightly in negative territory on the weekly PPO, and we haven't shown any real strength probably since back in 2018 in terms of relative momentum. So this is a group I think still needs to do some work. Next up, we've got commercial vehicles. I think this is a very strong group. Relative downtrend in place here for about 2.5 years. That has broken, and you can see very, very strong relative momentum to the upside. Delivery services, this is my favorite group. And I'm going to, go through my top 5 in just a minute, but I'll spill the beans here and show you this is going to be one of them for sure. Delivery services off of this bottom here in May, relative bottom. And there was a lot of volatility with the virus. Before the virus hit, this group was horrible relative to the S&P. The virus hit, we actually saw an initial jump, a surge in this group, went down one more time, and then the surge really took off. So delivery services has really benefited from COVID-19 in 2020, and I think is still poised to do well as we head into 2021. Then finally, airlines, and this was the worst performing group. And to be honest, it's still a group I'm very concerned about as we head into 2021. I don't know what the long-term effects are going to be for airlines. It's almost back in 2001, in 9/11, when the airlines, the terrorist act in New York City and so forth. It's going to be a while, I think, for airlines to fully recover and for folks to really trust getting back on an airplane and doing a lot of travel. I think there's going to be travel. I just think a lot of folks are going to opt for different forms of travel, recreational vehicles, more domestic travel as opposed to international travel. So I just don't know, business travel, is it going to be the same? A lot of folks using Zoom now. Are these airlines going to be able to make it? Which ones, if, some might not, some might. I just think there's too many question marks. So this is a group I would be avoiding still. All right, so that's a look at the 16 groups, with 2020 hindsight, no pun intended. So now I want to go in and look at the strength into year end. So, as I went through there, I pointed out a few of those that I thought, were really strong. Well, I'm going to give you my top 5 industry groups within the industrials as we wrap up 2020 and get set to move into a brand new year. And I'm going to start off with the industrial suppliers. So here is a 7-year relative chart on the industrial suppliers. And I think the thing that's important here is to realize that as we're making this breakout, we're looking to move to what appears to be about a 4-year relative high, industrial suppliers versus the S&P 500. And you can see down below, this is the absolute chart. And since that March low, I mean, we've gone from under 240 to above 440. It's been a huge move to the upside. And that's where this relative strength is coming in from. So this is a group I think that will continue to do well as we wrap up 2020. And I'm expecting some pretty good things out of it in 2021. The next group is the building materials and fixtures group. Again, 7-year chart. We were under, in a downtrend for a few years, and then things got kind of choppy here. But on this move, we bounced up, put a relative high in the fourth quarter of 2019, went back down, put in a higher low, relative low, and then we put in the higher relative high, which I think is really important because we're starting to show this pattern of higher highs and higher lows. So we're trending up. The relative PPO on this fourth quarter 2020 high, if you look at that relative PPO, it's the strongest that we've seen in the last 7 years. So I think Wall Street is moving into this group. And if Wall Street's moving in, it's certainly an area that I want to be at least considering. So my number 5 group, industrial suppliers. This would be my number 4 group, building materials. Number 3 group, heavy construction. Now, this is a group that's been downtrending for a long time, but I love what's going on here. And again, look at the relative PPO and the strength that we have seen over the last 6 months versus any other period in the last 7 years. And I'm essentially going back 7 years to look at, this is about the length so far of the secular bull market. When we took out the highs from 2000 and 2007, that actually occurred, I think, in 2013. That to me was the start of a secular bull market when you clear the prior highs. Otherwise, the secular bear market continues. So looking at this, though, heavy construction's not been a big performer in this secular bull market. I think that's changing here. This is the most significant relative strength we've seen in the group since the secular bull market began. And I think this could begin something much larger. So this is a group that I'm looking at very closely as we move into 2021. Next up, commercial vehicles. So this is commercial vehicles and trucks. I think, again, 2.5 years, you can see we had this relative downtrend in play. I think that all was broken here over the past 3 or 4 months. Also, we cleared a bunch of these relative highs. So I would have said 0.7, 0.71, 0.72, really big relative resistance. We went through that here in the fourth quarter. Again, relative PPO getting to levels we hadn't seen since, a few years ago, 4 or 5 years ago. So I like the momentum that's building in this group, and I think it carries over. And then the final group that I really like in the industrials to wrap up 2020 is the delivery services group. And, if you think about what's transpired in 2020 with COVID and how it's impacted things, people are shopping online. Delivery services. This is where a lot of, packages are coming from. These are the companies that are delivering those packages to everyone around the globe. Their businesses skyrocketed as a result of COVID-19. Now, maybe they pull back for a period of time, but I think Wall Street's getting in. I think it's going to at least start off the year with COVID still being a problem. I've got to believe that the delivery services group is not going to slow down anytime soon. So this is a group, and you can see the PPO, relative PPO got up to 10. So much money pouring into this area of the market. So I think this is a group on a pullback. I think this is a group we certainly could be paying attention to, or paying closer attention to as we jump into 2021. All right, final thing I want to do, last segment I want to go over is stocks to watch. So within those 5 groups that I just gave you, the 5 industry groups I think are looking really strong. I wanted to find one stock within each of those groups that I really like. So let me go over those one at a time. I'm going to start with FedEx. FedEx is in that delivery services group that I just mentioned. And if you look at a long-term chart, I'm going to go back and look at like a monthly chart. FedEx has been going up pretty consistently. Now, we did have with the trade war, you know, GDP was taking a hit. Trade war, I think, really had an adverse impact on stocks like FedEx. And then of course we had COVID to top it off. So this stock actually pulled back from about 260 down under $100 because of the combination of the trade war and then COVID-19. But look at what has happened since. I mean, FedEx has just soared back to the upside. The volume has poured into the stock. I believe that there's been a lot of accumulation that's taken place in FedEx, and I think it's in some very strong hands as we head into 2021. So my guess is pullbacks are going to be bought, and I believe FedEx is a stock that goes higher in 2021. Next stock, and let me get back to a relative chart. Let's take a look at FedEx relative. Look at the relative ratios here. Just about everything pointing up from left to right. That's what you want to see. I always refer to leading stocks and leading industry groups. That's where you want to invest. And I think FedEx is really a poster child right now for just that. Next stock up. And this is in the heavy construction area. I don't know, I'm not getting my chart up here. Let's try this again. There we go. All right, so Quanta Services. Well, you know, I look at the AD line, accumulation distribution, certainly seems to be accumulated. Great price action, super volume on the move to the upside. And then once again, as we look across these relative ratios, PWR, Quanta looks very, very strong to me as we head into 2021. So this would be another chart that I would be very interested in. Next up, probably familiar with this company, Deere & Company. Let's see if we can get this chart come up. Come on. There we go. Now, I will say the AD line's been dropping. That is a secondary indicator. I would feel much better if it was rising, and it was rising through much of the move to the upside. But it's hard to really argue that the stock's being distributed when you look down here and you see these lines all going up. I mean, this is a stock that's outperforming. So it's very difficult to outperform if your stock's being distributed. So I don't know that the AD line every time is going to, you know, be the perfect indicator. I do like to have it, like I said, I like it to confirm my stocks, but I think Deere has been in such a strong uptrend, continues to perform well. And like I said, the group that it's in has been very strong, and there are your relative ratios all rising. The fourth stock that I like in industrials is Generac Holdings. Generac Holdings AD line in this one actually has been pretty strong. We've been trending higher. And again, when we look across the board at the relative strength, I'm seeing mostly higher. Now you can look at this and say, well, yeah, but the last month and a half, it's been going down a little bit. Well, I think there are a couple keys. Number one, it's going down a little bit. It's not falling apart. That's a positive. The other thing is, and one of the things I always teach, is a stock that's moving higher as it's trending higher. I like to see it leading, which the stock absolutely was throughout its uptrend. When a stock goes through a period of consolidation like Generac is going through right now, it tends to lose a little bit of relative strength. Why? Because the market's still going higher. It led during a lot of the rally, but now it's taking a break, it's pausing, and it's underperforming a little bit. That's okay. We haven't done anything horrible to break down. Maybe if we lose this high, which is down around 195, or maybe these lows around 200, I think that's the key area to watch. But I think we're going to, after a period of consolidation, I'll look for the stock to go higher. And then the final one that I had is MSM, which is in the industrial supplier area. Beautiful move up, great volume, super push here across the board in terms of relative strength. And there's your volume trends. I see a lot of accumulation. MSM looks really good to me. So those are the 5 that I really like as we head into 2021. All right. I want to thank everybody for tuning in. I really appreciate it. Once again, this was a great show to be a part of. I think reflecting back on 2020, I don't think any of us are ever going to forget it. And I can only say I'm looking forward to 2021. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.